Understanding catalyst. So in this video, we are going to break down what is a catalyst, the different types of catalysts, and I'm going to go over certain trading catalyst examples. So let's get right into it. What is a catalyst? So catalysts are events that affect the price action in a positive or negative way and then create momentum. So you guys have probably heard this term before. If you haven't, this term is broken down into multiple different categories, right? So whenever you hear a stock have good news, bad news, earnings, or anything related to that, that is considered a catalyst. So when a catalyst is released, either from the company, from the public, from an investor, a big firm, whatever the case is, whenever a catalyst is released, a catalyst has the power to either drive a stock up or down. Now, these are some of the examples of a catalyst, right? You can have an earnings catalyst, company news catalyst, economic events, new deals, hires and fires, hype speculation, anticipation, big money plays, biotechs, upgrades or downgrades. So any of these could be a set of catalysts, right? Now, once again, a catalyst is any set of news, good or bad, that has the power to basically move a stock up or down depending on what catalyst it is. Now, catalyst is usually putting the fuel behind a stock's play, right? So for example, let's say stock is just trading normally, right? Now, if there is a catalyst that comes in play, be it a good catalyst or a bad catalyst, whatever it is, right? For this example, let's say we get a good catalyst, and the good catalyst is basically the company has great earnings, right? That good catalyst has the power to fuel the stock now, meaning the stock will most likely get a bigger push on the up or downside, depending on, once again, if it's good or bad. Now, the special thing about catalyst is when a stock does have a catalyst, that automatically becomes a company or it becomes a stock that we tend to follow or we tend to watch because there's a lot of interest around it, right? So for example, let's take stock ABC. Let's say stock ABC announces a new deal that, or actually let's take a real company. Let's take FedEx. FedEx is a company that ships internationally, ships locally. Let's say FedEx announces a deal that, hey, we just signed a 20-year deal with Amazon. Amazon is going to give us all of their shipments for the next 20 years, right? I'm just making this up. This is not real, so don't go into the FedEx stock looking into it. But let's just say they announced this set of news. Now, obviously, them getting this big contract is going to drive the company stock up because that catalyst of getting a deal for 20 years is going to affect their underlying business, meaning they're going to make more profit. Most likely, they're going to have more revenue. The company is basically growing and they've locked in a 20-year contract. With that being said, the market overall now focuses on FedEx, locks in on FedEx and says, wow, FedEx just signed this great deal. That's a phenomenal deal. And now there's a high probability that FedEx's stock may go up. And then we as traders are now interested in trading FedEx. Now, one thing a lot of people get messed up is a lot of people look at a catalyst and automatically place their personal opinions. They might say, okay, so FedEx signed a 20-year deal with Amazon. That's great news. Cool. That's one part of the catalyst. What you and I have to understand is we can't place our personal opinion on a catalyst. So if this catalyst comes out, this is the catalyst. That's the first component. A lot of people see the news and they react off it as the first component. That, okay, I got the first component. I think it's good, so I'm going to go buy FedEx stock. Now, we don't know the logistics of the contract. Right? We don't know how the market is going to react. What if this contract was a terrible contract where FedEx actually is barely making money, they're barely getting by, they're maybe even losing money on the deal, but they've signed it for 20 years just so their competitor UPS doesn't get it. Now, the market may see this catalyst or see this news or event or new deal and say, you know what? Nah, it's not good. And the stock tanks. So that's the second thing you have to understand with catalysts. that price has to showcase a play. Just because you get a set of news, don't automatically take that set of news and say, this is how I'm going to trade the stock. No, you have your assumption that this news came out. I'm assuming it's good. If it's good, this is my setup on the chart. But the stock's price needs to react to the catalyst. If the stock's price does not react to the catalyst, then I'm not going to take the trade, right? And that's very important to understand. Now, just to recap this before I show you examples, when you guys see catalyst, catalyst gives you stocks that are on the radar for a lot of people. So if I see a stock tomorrow in the morning that has good catalyst, that gets an upgrade, a downgrade, that stock automatically comes on my watch list. Okay, cool. This stock is being watched. There's probably going to be a lot of volume, a lot of trading going on here. So this is a stock a lot of people are watching, and I'm personally interested in it as well. And then I tend to trade that stock because of that catalyst, because of that set of news. Now, catalyst, once again, also creates that fire, that momentum, and fuels the stock on the up or downside. Whenever you see a catalyst, first thing you should do is obviously look at the catalyst and then jump onto price action as a trader. You look at price action, you look at a chart setup, and then you take the trade from there. So now let's jump into some examples of all these 9 points that I laid out, and let's go through each and every single one of them and understand the catalyst. All right, so first we have earnings. So let's just go over earnings real quick and I'll show you guys examples. So earnings. The SEC requires public companies to file earnings reports every quarter. Remember, every quarter is 3 months. The SEC, once again, these reports are required. So a company is reporting earnings after every quarter. There are 4 quarters in a year. Each quarter lasts for 3 months. After 3 months end, a company will then report earnings. In earnings, an earnings report provides shareholders with all the necessary information regarding the financial health of a company. How much money do they have in the bank? How much money are they making? Are they growing? Are they not growing? All of these things are showcased on their earnings report. Playing earnings is never a good idea because there's so many factors involved that could switch the direction of the stock and you basically have no edge. I don't play earnings. If I'm trading a stock and a stock has earnings tomorrow, I'm not playing it because there's no way for me to know how the stock is going to react. There's no way for me to know if the stock is going to have good earnings or bad earnings. These things are something that I can't really have an edge on, so I personally don't play it. If a company misses or beats those expectations, it may, quote unquote, may give that stock a boost in that direction, right? It's important to understand that earnings numbers alone aren't as important as the reaction to earnings. So now I'm going to break all of this down in a few different concepts, right? So let's break that down. So now let me break down the concept of earnings, right? So now there's companies that have analysts behind them, and analysts make these predictions. So earnings numbers are not random, right? So this is what I want you guys to understand about earnings, because a lot of people that first get started in trading and people that even have been trading for quite some time don't understand this. Now, when a company announces earnings, let's say a company comes out and says, we made $4 million or we made $40 million. Some people might look at this and say, wow, they made $40 million. The stock went down. Some people might see that a company announces earnings and they lost $40 million, but the stock went up. Now, this tends to confuse a lot of people, but you have to understand the logistics and the whole idea of how earnings operate. Now, the way earnings operate is, as I mentioned, this analyst. Analysts come out and they say, we think Apple is going to have revenue of $400 or $45 billion. Apple is going to have revenue of $45 billion. Apple is also going to have profit of, let's just say, $10 billion. This is what we expect Apple to do, right, for the year. Now, when Apple has earnings, if Apple has revenue of $45 billion, cool, they meet earnings. If their profit is $10 billion or more, cool, they beat earnings. Now, sometimes Apple may project these numbers and the stock still can go down. And that's what people don't understand about earnings. They're like, okay, all Apple has to do is they have to meet the analyst projection. And if the analyst projections are met, that means Apple is going to go up. No, that's where you're wrong, right? Because Apple can release phenomenal earnings and say, well, our quarter three was great. We actually had revenue of 47 billion and we made profit of 15 billion. We did very well. The numbers for quarter three were phenomenal. But Apple can come out and say, well, guys, next year, we're not growing as much. We think our sales for the iPhone are going to go down. We think our Apple Watches aren't going to sell as much. We think our Macs are dying out. So next year, we're kind of going to slow down. Now, what do you think is going to happen to the stock? Do you think the stock is going to go up or go down? The stock is going to go down most likely. Why? Because analysts and investors and traders care about future growth. Once they see growth die down, they're running away. Big money is running away from that stock. And that's going to cause the stock to take a hit. Now, other factors, you might see that a company is expected to make $500 million in revenue, and they are expected to lose $80 million, right? Now, the company comes out, they make $500 million in revenue, but they only lose $70 million. Now, one person may look at this and say, well, they lost $70 million. What a bad company. Yes, very, very bad. Okay, cool. But in the market, these companies are growing. So when these companies are growing, they're not making money initially. Apple, Amazon, all these big companies that you guys see now are very, very massive. They weren't making money during their initial stages. So when the market sees this, the market doesn't care that they lost 70 million. They care that, okay, A, they lost less than anticipated, and B, how are they growing? Is this company growing or not? Now, if they see that this company has growth, it's still growing, then cool. The stock has potential to keep going higher. But if they see it's not growing, investors and big money tends to pull back, right? Now, the thing with earnings, as I was saying, it's kind of impossible to predict what's going to happen. A company can have good earnings, bad outlook, stock can fall. Sometimes a company has bad earnings, bad outlook, stock stays flat or whole or even goes up depending on something said on the conference call. So there's a lot of different combinations, right? So getting the perfect mixture on playing earnings is very hard. So once again, me personally, I don't like to play earnings. Now, let me show you guys some examples of stocks that had earnings and you guys can see what happened. So right here, we have stock ULTA. Now, Ulta had earnings of $8.29.19. The earnings per share, actual number was $2.76. Expected was $2.80. Now, if you take a look at the stock gapped down from $320 to about $250 all the way to $230. So huge gap down. Now, the reason it gapped down was obviously earnings, but let's understand that once again. Actual numbers was $2.76, expected was $2.80. So they missed earnings. They missed their earnings per share. That's number one. Number two, their actual revenue was $1.67 billion, and their expected was $1.68. So they actually missed on revenue too. Cool. But this miss on earnings usually doesn't cause this massive drop. So why did the stock drop so aggressively? Why was there a huge gap down? Now, the reason for this huge gap, the main reason for the stock sell-off was that they lowered their forecast to 11.86 to 12.06 per share from prior range of 12.82 to 13.83. So basically, instead of getting into the nitty-gritty of all the numbers, they lowered their forecast for the year. What the company said is that we are cutting revenue and we are cutting growth. We don't think we're going to grow as fast as we did. Our company is taking a hit, right? So this is what we anticipated on our earnings per share before. Now we're anticipating this, meaning their expectations were here and they had to lower their expectations. Now, obviously, when people are trading the stock, investing, buying, they're buying based off this expectation. So when that expectation gets lowered, that is obviously going to affect the stock very, very hard. Now, maybe you could have somehow predicted this. Maybe somehow you could have predicted that. But this right here becomes very, very hard for us to kind of have an edge on, right? And that's the main reason this stock took a very, very huge hit, right? Because of future potential growth. And you guys can see the gap down. Now, whenever there's earnings, we know, like we're well aware when earnings are. So if you're trading a stock, it's not like earnings just randomly come out. A company wakes up one day, the CEO wakes up one day and he goes, okay, I'm going to announce earnings today. Surprise. No. They'll let you know beforehand that on 8/29/19, we are going to have earnings. We are going to release our numbers before or after the market closes. These earnings come out before or after the market closes, so we are well aware. So if you're trading something and holding it overnight, be careful about this. Have a solid understanding that, hey, this is what's going on. There's earnings. Do I want to hold this overnight? No, it's very, very risky at this point. So no, I'd rather not hold this overnight. Trade, fine, I'll trade it, but I'm not holding this stock overnight because me playing earnings is kind of gambling because I have no edge. Now let's look at the next example. Roku. So if you guys just look at Roku's chart, you can see Roku has earnings. Roku gaps up. Goes from $100 to about 122, 123. Makes about a 22, 23% move overnight after earnings. Phenomenal. Right? Phenomenal move. Now, what happened here? Let's understand. So Roku's actual number, earnings per share, was negative 0.08. So based on each share, the EPS was 0.08. So they lost money per each share. So Roku lost money, right? This is a clear indication that Roku is losing money. Their expected was negative 0.22. Now, even though Roku lost money, right, their stock still went up. Now, like I mentioned before, Wall Street does not care about a company losing money, especially if a company is growing. Roku is in a stage of growing. They're a growth company. You can see for the year, Roku stock was at about 26. For the whole year, it went from 26 to about $123 now, right? In about 8 months. That's huge. That's because they're growing. So Wall Street does not care that they lost money. They want to see that the company is consistently growing. Now their revenue was $250 million, up 59% from the prior year, which is huge. Very, very, very good. So they're showing growth, right? They're showing growth by they're losing less money. Yes, they're losing money. That's fine. So they're losing less money, which is a good sign, right? Even if they were losing more money, at times for companies in this situation, still okay because there's other metrics that the market is focused on. Their revenue goes up, meaning their sales are going up. Now, the main reason for the stock increase was that they surpassed 30 million active accounts, meaning they're growing. So their user base surpassed 30 million users, which is like, wow, they're growing. Their average revenue per user also jumped, and they added about 1.4 million new accounts in this quarter. So all of this right here is what the market cared about. The market doesn't care that they're losing money because at this pace, what the market basically predicts is, okay, they're losing money now, but in the long run, they'll make money. They're growing. They're in the early stages, so we're okay with that. And with that being said, stock went up. Now, if let's say we had this, they beat earnings, right? They beat the earnings per share. They beat their revenue expectations. Everything was good, but they did not show growth. They did not show that they added 1.4 million new accounts. They maybe added, let's say, 2,000 new accounts, right? Now, that itself would most likely make the stock fall very hard because now the street goes, wow, the growth is done. People are not interested in Roku anymore. There's no growth here. And then the stock starts falling. So there's certain key metrics in earnings that companies pay attention to. So there's no real way of anyone looking at a stock and saying, oh, I think Roku's going to go up. I think Roku's going to go down because there's different key metrics that investors are looking for based on every company out there. Once again, playing earnings is not a good way to trade. Let's go over one more. Now we are looking at Facebook earnings. Now, Facebook had earnings on July 25th, 2018. You can see stock was at $218. It gaps down all the way to $175. Now, the earnings per share were $174. They basically beat by 3 cents. So they beat earnings per share. Great. Their revenue was $13.23 billion. They missed by $120 million. So cool, they missed. Right now, very, very choppy. Now, why did the stock gap down? Obviously because of earnings, but what was so big on earnings that made the stock take a massive, massive hit? Now, the main reason for stock sell-off was because guidance was decreased. The company stated that they see growth rate dropping by high single digits for the next couple of quarters. So basically, they're saying, hey, our growth the next few quarters are going to decrease. Now, obviously, anyone watching Facebook around this time, they're also going through a lot of other problems, which I'm not going to jump into yet. But just off earnings, the stock took a massive, massive hit. And that massive hit was because, hey, we are not growing as fast as we thought we would. We're actually slowing down right now, whatever the reasons are. And that causes investors to take a back seat. And that's what happened with Facebook here. So this is just showing you that there's so many different key metrics that go into earnings that to predict perfectly what's going to happen is legitimately impossible because there's so many factors that go into it. Now, another factor before we move on from earnings is when a company does have earnings, right when they announce earnings, they usually have a conference call. I'm going to put CC. So in the conference call, the company CEO, CFO, like the major executives of the company get on the call and they kind of speak to us shareholders and they give us an update, which is all available to us. If, let's say, Facebook has earnings tomorrow, we can access their conference call on their website. Just go to facebook.investors.com or search it on Google, Facebook investors, Google investors, Apple investors. You'll see the full conference call. On this conference call, the company executives speak, give us an update. Sometimes what happens is everything here looks good, and on the conference call, there's certain questions that are asked which didn't have a great response to, and that caused the stock to either go down or go up depending on what the response was, right? So it's very important to understand that there's so many factors that play a huge role in earnings. Now let's go over the next catalyst example. Now the next catalyst example are company news. So companies at times release news on their own to the public and at times depending on what the news is. The stock price reacts. So depending if it's good news, bad news, obviously the stock will then react. Companies are required to inform their shareholders about any major events happening within the company. So if a company has a major event, they're required by the SEC, once again, the Securities Exchange Commission, the cops of the stock market, they're required by them to report any event to us shareholders. Now let's go over some examples. So if you guys take a look here, this is stock Boeing. You can see stock Boeing takes a big hit here. So what happened? So Boeing 737 MAX has been in trouble after 2 fatal crashes, which killed a combined 346 people, leading to the grounding of the plane worldwide. So if anyone that doesn't know Boeing makes planes. Two of their planes actually crashed around this time. When their plane crashed, their leading planes were grounded, meaning they weren't allowed to fly. Now, something like this happening is obviously very, very sad. Affects many lives. I 100% understand that. But when we go on the trading aspect, how does it affect the company? It affects the company because now they're gonna get sued. They're gonna get fined. The stock's gonna most likely take a hit. Their planes are gonna have to get reviewed. Right, so if you take a look here, FAA started an investigation into the plane's approval process and found out on October 18, 2019, that the company may have misled officials probing the grounded 737 MAX airplane. As soon as the news hit the markets, Boeing stock plummeted, closing nearly 7% lower than opened. Right, so after the investigation process, they found out that the company made misleading statements regarding the plane, and that made the stock tank. So this right here is a catalyst. Now this catalyst obviously is affecting the stock price in a negative way. And what catalysts do for us is when we get these type of catalysts, and let's say it comes out pre-market before the market opens, we now have a stock to play. We now know Boeing is on the radar for us. Boeing has announced negative news. There's a high probability Boeing is going to sell off. So we as traders look for a good chart setup and we execute that trade if the chart is presented on a good setup, right? And you can see what happens. 7% move down, very, very strong move down. These are the plays we want to see. When we get into scanning, I'll show you guys how to find these catalysts, how to find stocks that moved up or down very aggressively throughout the day or pre-market or after hours. We'll jump into that when we get to that lesson. But for now, I just want you to understand the catalyst aspect of how it affects a stock in a good or bad way. Now, if you take a look here, looking at Roku. So on September 4, 2019, Roku expanded its product portfolio and announced two new products, Roku Smart Soundbar and Roku Wireless Subwoofer. Launch of these new products reinforced Wall Street's confidence in Roku's ability and performance. Roku shares rallied that day as market cheered the positive development. Now you guys can see Roku opens, obviously up well on pre-market. Good news comes out. This stock obviously becomes a stock that we are watching because there's good news surrounding it. We start watching it once price action gives us a go, we then take the trade. We do not, once again, we don't take the trade unless price action tells us something. Price action doesn't tell us to go. The chart doesn't tell us to buy or sell or short, whatever. We don't trade. Keep that in mind, guys. Now, here's another example. Now, marijuana legalization in Canada. So in 2018, Canada legalized marijuana, and this created a lot of demand and momentum for the marijuana industry. Companies that did business in the marijuana industry saw massive growth in their stock prices. So you guys can see, this is one marijuana company. You guys can see during that whole period, right? You can see there's massive growth in marijuana stocks. This is one marijuana stock. Now, if you guys take a look right here, you can see this is the day it got legalized, right? So the day it got legalized, so basically around here is when they announced that, hey, we're going to legalize marijuana in Canada. Great, phenomenal. That whole industry is kind of booming. Now, what a lot of people didn't understand is that this is all the hype that's going into that. So the news in this situation got baked into the price already. So the day they got legalized, everyone's like, okay, now what? Okay, they're legalized. They're approved in Canada, now what? And the stock obviously dumped because now there's nothing else to look forward to. Smart money understood that price is already factored in. They made their money in between, but before the event, they got out. Dumb money held, and they're like, oh, well, they're getting legalized in 16th. It's going to maybe keep going higher. No, this whole move already got factored in. And you can see the stock was at 450. When the legalization happened, it's up about 300%. It's up to $12.53. Right? It makes a high of $12.53. So it's already up 3x. Right? And that's huge. So at this point, right, the news already factored in. As a trader, trade here, trade here, trade here, cool, phenomenal. But be careful holding into that. Be careful on that announced date because once that announcement happens, you can see stock tends to dump. This is one stock, ACB. Let's look at another one, CGC. This is also a marijuana stock. Same exact example. News comes out. You can also see with the news, a lot of volume kicks in. This starts going up very, 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 very aggressively. You can see when the date comes out, when the stock actually, when marijuana actually gets legalized in Canada, you can see what happens, starts dumping. All the hype gets built in, gets legalized, dumps, right? So just understanding that aspect of catalyst is completely, it's completely different and very important because now it would have been very different if they just announced this day that, hey, marijuana is approved. It's legalized in Canada. Boom, it jumps up and then maybe slowly sells off. But we had over 2 months to kind of process the information, drive the stock price up. So the price and the news was basically factored into the price at this point. So at this point, there's like, okay, there's no more new information. Now what do we do? And people started selling pressure gets created, and obviously a lot of stocks in the marijuana industry took a hit then. Now here's another example, Roku. So on September 10, 2019, Apple, during their event, announced that they will be entering the streaming space, which directly affected Roku, right? Now, Roku is in the streaming service, right? So Apple, being as large as they are, if Apple enters that space, now this is where connecting the news, connecting the dots gets a little bit more complicated. Now, Apple being the big company that they are, once they announce news like this that, hey, we are entering your market, we are going to compete with you. Obviously, people don't know the full logistics, but just that competitive side or competition kicking in is obviously going to affect any company that's in that industry. So Roku being in that industry was a stock to watch. Okay, Apple obviously has their event. Oh, they announced Apple TV. Okay, I know that the 151, the 150, 149 zone is very strong for Roku. Cool. Roku breaks that. Boom, short or buy puts, you have a phenomenal trade right there. Catalyst play, intraday catalyst play, because it's coming when the market's open, it's happening midday. Great play on price action, great level getting broken. Boom, you now have the fuel behind this move. And you can see volume obviously surges up too, showcasing aggressive selling. The sellers are more aggressive at this point. Now here's another example. So we're looking at Starbucks. So on June 20th, 2018, Starbucks announced that they are closing more than 150 US stores. You can see right there. As that announcement happens, the stock does what? It gaps down, and this is the whole move you can capture on the gap down play. And I'll show you guys how to play gap ups, gap downs, how to play catalysts, how to play earnings once we get to that topic. But for now, once again, I want you to understand. Now, then when they announce this news comes out most likely pre-market. When it comes out, we kind of can prepare for the day. We can put Starbucks on our watch list. We're now watching the stock. We're narrowing our focus down on Starbucks or whatever other stock that has a potential play. And then when the market opens, depending on what price action shows us, we take the trade from there. And you can see Starbucks announcing that news, 150 stores. We wait for price action. Price action shows a sell-off. We take the trade. Now, sometimes a company closing 150 stores might be like, wow, they may be closed the worst performing 150 stores. Maybe they were in bad areas. So waiting for price action is very, very important. Just because a company closes 150 stores doesn't always mean that the stock will go down. You need to look at price action and say, okay, price action is confirming there's a sell-off, selling pressure with news that I think is bad. Good combination, take the trade. All right, next, economic events, right? Now, company stock prices and the market in general can be affected by world events such as trade wars, civil unrest, natural disasters, economy-related news, central banks, policies, and so on. So any economic event worldwide can affect and does affect the stock market. These influences can be direct or indirect depending on the sectors of the market, technology, energy, and so on. So once again, any major market event, any major economic event, even war, any set of news, economic event that's happening like the Fed meeting, anything related to that, Trump tweeting something as simple as that can affect the overall market, right? So let's look at some examples. So here we are looking at the S&P 500. We're looking at the overall market. So President Donald Trump in 2018 began setting tariffs and other trade barriers on China with the goal of forcing it to make changes to what the U.S. says are unfair trade practices. The U.S. increased existing tariffs on $250 billion in Chinese goods to 30% from 25%. Tensions between Washington and Beijing whacked the entire stock market, leading to a market sell-off. You guys can see, huge market sell-off. Now, this is happening because we are placing, USA is placing tariffs on China. They're increasing tariffs, which is creating a huge trade war between the two largest economies. That trade war and that tension between two large economies is ultimately affecting the market. Now, if the market starts selling off, that is going to ultimately affect our companies. It's going to affect the big names. So if there's negative news within the market, right, there's negative catalyst, negative event, whatever, that will ultimately drive the market down. And if the market is selling off based off negative news, negative event, major stocks are also going to take a big hit. Now, if you guys take a look right here, we have another stock, Apple. So Apple had great earnings and stock gapped up and opened strong. So if you guys take a look right here, Apple had earnings. So you can see Apple obviously opened at 216, went to a high of 222 about. Very strong earnings, Earnings were great. Stock gapped up. Very strong, phenomenal earnings play. But the same day Apple had earnings, there was a FOMC meeting, right, which caused the market to be very choppy. So that same day, the Feds had a meeting at 2 p.m. Eastern Standard Time, which is known as the FOMC meeting, where the Feds set rates, interest rates. What are they going to do? How are they going to move forward? Once this happened, the whole game plan, or the way the day went, Apple had earnings, great earnings. But we are now approaching the Fed meeting. Now everyone is waiting. Fed meeting gets announced. Obviously, results were not great. Market did not expect that. Market started selling off. And you can see other factors as well with the market. You can see Apple started tanking. Now, progressing and moving forward, when we look at the intraday chart, now I'm going to zoom into this day. This day right here, you guys take a look right here. I'm going to zoom in onto that day. I'm going to zoom in and I'm going to show you guys. So now if you take a look here, you can see earnings, right? After hours, stock goes up, consolidates. On the open, Apple makes a strong move up. And then throughout the day, it starts fading, starts getting choppy, starts selling off. What happens right here? Right here is when the Feds announced their meeting on the interest rates, and they were basically like, hey, we are not looking to cut anymore. We're not going to cut any more rates. We're not going to cut any more interest rates. We're going to keep it the way it is. Obviously, the overall market did not like this. Now, the FOMC meeting, as I mentioned, is a very important day. It's a very important meeting, right? So whenever there's a meeting happening, whenever the FOMC meeting is happening, you need to be careful of the markets, because the markets are very, very choppy, as I mentioned in the economic section, right? So whenever the FOMC meeting is happening, if it's happening, it's usually on Wednesdays. When that meeting is happening, you'll see the market is very choppy. And usually when 2 p.m. comes around and that announcement kicks in, just be careful on being in a position, because depending on the news, the market can reverse. Now, if that meeting was not this day, right, Apple could have maybe kept surging, maybe held, had a nice, phenomenal gap play. But as a trader, you need to be aware of these events and say, well, there's the FOMC meeting, so I got to be careful, and I'm not going to hold within that period. Or if I do make my money, I should get out very, very quickly, because I understand what happens during these time periods, right? So next example, new deals. So company stock prices can get affected whenever a company announces a merger or acquisition deal or a cooperation with another firm. Such deals showcases a company's ability to expand, create healthy cash flows, and potential increase to investors' dividends, right? So here's an example. So if you guys look right here, company CGC, they basically sowed the seeds for a U.S. expansion in April 2019, when the company reached a deal to buy the rights to acquire the U.S.'s holdings for $3.4 billion. So they announced a new deal. This deal obviously was probably a great deal looking at price action. So even if I don't know anything about this deal, just looking at price action, looking at how price is reacting to this, it's showcasing that this was a good deal. The market reacted in a positive way. Now, sometimes a company can have a good deal, like I mentioned with the FedEx example, which looks great at front, but the stock may tank. So you always want to wait for price action, and you want to see what price action shows you. You don't want to look at price action and say, you know what, I'm just going to take the trade because there's a new deal. No, sometimes new deals are not great for companies because the structure of the deal is bad. That applies to every single catalyst. When you see a catalyst, once again, I want to keep bringing this up because I want this cemented in everyone's head. Catalyst, and then you look at price action. These combined give you a good trading opportunity. You're seeing that the first 30 minutes stock was not moving up. Here it breaks pre-market highs. It breaks the level it got rejected from. We have good catalyst. We have a new deal that's giving you a solid entry, and you can see stock makes a solid 2-point move up. So once again, catalyst, and you need price action confirmation to get the trade. A catalyst itself is not enough. Now, next example, hires and fires, okay? Now, company stock prices can get affected whenever a company announces to lay off or hire. This showcases a company's competitive position in the market. Hiring may indicate that a company is expanding and there is demand for its products. Layoffs is it basically showcasing overall weakness. It's showcasing that the company is having maybe financial troubles. They maybe can't keep up with all of the payroll, all of the employees, so they maybe have to downsize. Now, as I mentioned, you want to look at news and you want to look at the reasoning behind it. Now, sometimes you guys are going to see companies are firing employees because they're going towards automated workers where they're going through machines. They have AI in place, so they don't really need humans, right? So what they do is they get rid of certain humans, so they are going through a firing process, but it's replacing them with AI, right? So just reading through that is very important because you don't want to see, oh my God, stock ABC fires 210 people. And you look at it like, wow, they fired 210 people. Read into it. Why did they fire 200 people? Oh, they fired 210 people because they weren't needed anymore because they now have robots that replace them, right? Whatever the case may be. Sometimes you see something like this and the stock does tank because the company can't keep up, but looking into it is very, very important. So let's go over an example. So right here, on January 18, 2019, Tesla CEO Elon Musk announced thousands of layoffs and laid blame on a pursuit of profitability, right? Elon's announcement sent the stock down 13% by the end of the trading day. So you guys can see, he says he's cutting 7% workforce. You can see what it did to the stock. Now, investors seeing that a company is cutting workers off, employees off right off the bat sends a bad signal. Wow, they can't keep up the cost. And that's what happened with Tesla. So when this email was released, when this set of news was released, it set the stock going down very hard because everyone looked at it as, wow, why is a company like Tesla that's growing laying people off? That's not a good sign. And that obviously created a lot of fear, that created a lot of uncertainty in the market, and the stock tended to take a huge hit, and you guys can see 7% move down. Next, hype, speculation, and anticipation. Now, hype, speculation, and anticipation are all within a subset of news, right? Stocks that move based on these factors are very hard to play unless there are very strong factors that drive the price up or down. Be careful with trading stocks based off these factors because if the rumor ends up not being real or the hype dies down, the stock usually takes a huge hit. So there's at times you'll see rumors floating around that company X, Y, and Z is probably going to get bought out by this big company. There's speculation, anticipation of some big event, some big product announcement happening. Sometimes it's real, sometimes it's not real. So if you're trading these type of stocks, you got to be in and out quick. You can't hold it for a long period of time because if you do and that hype, speculation, or whatever people are anticipating does not end up being real, it will massively affect the stock's price and will cause a major, major sell-off. All right, so if we take a look right here, we're looking at stock BYND, Beyond Meat. This company IPO'd in 2019, and you can see after they IPO'd, after they first came into the market, the stock started surging based off hype that this company is going to get into this new industry and dominate that whole industry, which is phenomenal and great. But you have to understand, at a certain point, there's valuation on how much the company is valued at. Now, this company went from $45 all the way to $240. So this company that makes burgers without real meat was basically valued around 11 to 12 billion dollars. Now, when people looked at their sales, their future projections, none of this made sense. Now, the only thing that made sense was that there was a lot of buying pressure here. That buying pressure was causing this stock to go up. Now, why was there buying pressure? Because everyone was buying off hype that this new company that makes burgers, or it makes burgers with fake meat, is going to dominate the industry, and everyone started buying the stock. Everyone. Now, as there was buying pressure, you can see that hype made the stock go all the way up to $240. and this stock currently is around 138, and it's still bleeding out more and more each and every single day, right? So you have to be very careful when you buy into companies that are surrounded by hype. Now, I'm not saying don't trade them. There's a difference of me saying don't trade them, and there's a difference of saying understand what you're walking into. I've traded this stock, BYND, multiple times this year, but I almost never held it overnight because I was like, it's surrounded by too much speculation, too much hype. I don't want to wake up one day and the stock is down 20, 25%. I'll day trade it every single day. If I see an opportunity, cool. If not, I'll wait on the sidelines instead of me holding it. Yes, if I held around this time till 240, I would have made X, Y, and Z amount. But obviously, no one really anticipates it's going to 240. No one knew it was going to go to 240 and start selling off. A lot of people anticipated that here it was going to start selling off or here, right? So there's no real way. Obviously, if you look back at this now, we're like, oh my God, if I bought it at 80 or 40 or 50 and held it, I would have made X, Y, and Z amount. No, that's not realistic because we don't know when the hype is going to die down. But the whole idea is when you do trade stocks like this, and like I said, I'm not saying don't trade these, but when you do walk into this, just know what you're walking into. Know that this is surrounded by hype. Know that you're not going to hold it overnight. Just understand and accept that and then day trade it, but don't hold it overnight because when the hype dies down, these stocks crumble and fall very, very hard, right? Now let's look at another example. Now if you look at here, this is Tilray, TLRY. For people that have traded in the past, probably know this stock and know what happened. Stock IPO'd at 20. They opened at 20 when they IPO'd. Stock went all the way to $300 in about 3-4 months. So that is a major move up. Once that hype died down, you can see what happened to the stock. Down over 50%, way down, over 70%, 60% right here. And you don't want to get caught up in that. Now, once again, trade it, capture these moves. If you see a good trading setup, make your money. But don't end up holding and then getting crushed within the stock and thinking it's going to go to the moon or thinking that it's going to keep going higher and higher. These set of stocks are surrounded by hype. Trade it, make your money, and run. But do not be stuck into the trade and do not fall in love with it to a point where it's like, wow, I love this stock. It has made me money every day. Or do not get into a point where you don't want to fear missing out anymore. Oh, I could have bought at 40. I could have bought at 50. I could have bought at 60, 70, 100, 200. Oh man, you know what? No more. I got to buy now. And then you end up buying right here. And next thing you know, you're now a long-term investor without wanting to be a long-term investor, right? So don't buy into the hype. If you do buy into the hype, trade it, get out. Make your money, get out. Make your money, get out. That's it. That's the mindset. That's the way you should approach these type of stocks. Now next, big money plays. Now company stock prices can be affected whenever big money shows its interest in a company and decides to invest. Such interest showcases the asset's potential to grow, right? So if let's say a big billionaire, a big institution steps in and purchases a stock and they let everyone know that, hey, we purchased X amount of shares of this stock, that showcases a strong catalyst play where, wow, this person is interested. This big institution is interested. Why are they interested? What do they see? What does this smart money see? What does this big money see? So that creates a lot of interest and drive for that potential play. So if you guys take a look here, stock RH. So Warren Buffett buys 1.2 million shares of the furniture retailer RH. Shares of RH surged more than 7% after the news came out. So news comes out, Warren Buffett, he's a billionaire for anyone that doesn't know. He's a great investor. He has a huge company, and he's built all his fortune off investing, right? So he's very well known in taking great positions, great plays, getting into great companies and making them great. So in this situation, you guys can see he announces this, RH shoots up, phenomenal play, and you can see what tends to happen, right? Now moving forward, let's look at another play. All right, let's go right here. Now moving forward, biotechs. Now biotechs are kind of interesting. Now biotechs, these are pharmaceutical companies that specialize in creating medicine and drugs. Biotechs follow a set of rules through a development cycle, which I'm going to show you guys in a bit, that is involved in the creation of a drug. So whenever a drug is being created, it goes through a development cycle and it needs to be approved by the FDA. Okay? Now, biotech stocks are very hard to play because there's a lot of news speculation, which is very hard to predict. Now, you guys have probably seen these type of plays. This is a biotech play. This is BPTH. So stock BPTH jumps over 100% right here. So you guys can take a look. If anyone watched BPTH in 2019, you guys saw how it made a massive, massive move. So BPTH was trading about $1 to $2 range. Good news came out. Volume surge, everything. Stock goes from 2 all the way to about 8. So makes a massive move in 2 days. Now, the massive move was made because this company announced upcoming data presentations at their AACR supporting their DNA-Belize technology. So they have some technology, all relates to biotech, right? It's supporting medicine, it's supporting a pharmaceutical cause, and these sets of information is creating a lot of demand and a lot of interest, which causes buying pressure, and that buying pressure obviously makes a stock start rallying. And that's what happened. Now, when you see these type of plays, and if you're in a stock that goes up 300%, 400% in a day, in a short period of time, guys, take your profit and run. If you're in a stock that's up 300%, don't fall in love and say, well, I'm up 300%. I think it's going to go up. No. You're up 300%. Take half off and take something off the table. Take off your initial risk. Do something, and I'll go over that in managing your trade, but you need to learn how to take risk off the table. It's very, very important. So if you're in any of these type of trades and you're the person that wants to trade biotechs, you want to trade these crazy movers that move up or down very aggressively, cool, that's fine. But learn how to take your profits, right? Here's another biotech stock. Before I get into another biotech stock, let's go through the cycle. So as I mentioned, these biotech companies that make the 100%, 200%, 300%, 500% moves up or down, they go through an FDA approval. So for their drug development process, for them to develop a drug, they need to go through 4 stages with the FDA, right? They are the ones basically that approve the drug. Phase 1, discovery and development. Phase 2, preclinical research. Phase 3, clinical research. Phase 4, clinical trials. So there's 4 development stages. Now, usually, the way a lot of biotech companies work, especially the smaller ones, the penny stocks, the companies that are trading for $2, 50 cents, and so on, they will operate like this. Let's say a company is trading at $2.77. They're on stage 1. They announce that, hey, our stage 1 is good. We passed stage 1. Amazing news. Hey, shareholders, look at us. So the chart goes from 277 to maybe like 650. The stock makes a 200%, 300% move up. Very strong move. After that happens, the company goes, yeah, we passed phase 1. And this doesn't happen with every company, just some companies. They go, we passed phase 1. Now we need more money for phase 2 or for phase 3, whatever the case is. And then they raise money by selling shares. As they sell shares, right, and they're raising more money, that typically causes the stock price to take a hit. And then the stock tends to dump, right? So here's a clear indication. So you guys can see stock seal was up 40%, 47% on a license of potential Parkinson's disease candidate. So they're up about 47% or even more, right? The next day, they did an offering. Basically, they've raised money by selling shares. Hey, here's good news, investors, but now we need money. After they do an offering and they dilute the shares, right, that causes a lot of selling pressure and the stock dumped. Now, the message I want you to take away with biotechs is not that, oh, they're bad, but be very, very careful holding them overnight, guys, because if you hold them overnight, yes, you can make a lot of money, but you can also lose a lot of money, right? And I'm not a fan of holding these positions overnight. Trade them, go crazy, but close out your position by the end of the day. And you have to understand, these type of stocks, long run, always really kind of go down. You'll see these pops up and down, but these pops are happening because of announcements of a trial being moved forward, them getting approval on a phase, whatever the case is. But in the long run, these stocks consistently take hits. And you just don't want to be on that side where you end up buying the stock at $4, $5, and next thing you know, the stock is now at 80 cents. If you guys look at stock seal right now, you'll see it's around 80 cents. And from this point of March 8, 2019, the stock dumped 80, 90%. And that's what happens with these type of companies. So you have to be careful. The goal is to go in, make your money, get out. Make your money, get out. Go in, make your money, get out. The goal is not to hold and fall in love with these type of stocks, which is why I want you guys to understand this and cement it into your head. Okay? Now, last one. I know this was a very long video, but I want you to understand that catalyst is very, very important. And just, absorbing all this information so when you guys see it, you understand the whole concept. Now we're looking at upgrades and downgrades. So a company's stock price can get affected whenever a company gets upgrades or downgrades from financial institutions. Upgrades or downgrades showcase Wall Street's expectations in a firm's ability to perform. Analysts raising their expectations for future earnings often result in a higher share price and vice versa for the other company, right? So analysts, they kind of work like this. So let's say Apple announces earnings, right? Apple has good earnings, bad earnings, whatever. They announce earnings. Analysts step out, they look at earnings, and they say, okay, Apple is trading at $250 per share. We think Apple is worth $280. I think Apple's worth $270. I think Apple's worth $285. Now, does this mean Apple is actually worth $280, $270, $285? No, that's their prediction based off the information they have. But this is a catalyst. This creates momentum. This creates interest. People start looking at it and say, wow, this analyst thinks Apple's worth $280. If Apple goes up to $280, that's 30 more points. That's $30 more on the trade. If Apple can go up, that's phenomenal. So you know what? Cool. Now there's interest. Now sometimes people might come out, analysts might come out and say, you know what? Apple is now worth $250. Apple is worth $220. Apple's worth $210. Apple's worth $150. They're downgrading the stock. And now as they downgrade the stock, they're saying that, hey, I think this is going to go lower. I think it's going to fall. And that has power to maybe move the stock down depending on where the upgrade or who the upgrade or downgrade is coming from. Right? So let's look at some examples and before we wrap it up. So right here, you guys can see Beyond Meat. On June 11, 2019, JP Morgan downgraded Beyond Meat from overweight to neutral. Analysts cited increasing competition and company's current valuation positioning as the driver for the downgrade. Following the downgrade, BYND shares plunged nearly 25% through the trading day. Now, analysts are coming out, JP Morgan, very well-respected analyst in the marketplace, right? Very well-respected company. So now them coming out and saying, hey, we think that they're overvalued, right? We think that they're not really worth that much is obviously going to affect the stock price. And that's exactly what happened. 25% drop. Now, did we know it was going to drop 25%? No. All we knew is at this point we have catalyst. Now, if the chart shows us a certain price action move, we can take on the trade and take the trade from that perspective, right? Now, if you guys look right here, another stock, NVIDIA. So NVIDIA shares are trading higher after Bank of America maintained a buy rating on the stock and raised the price target from $225 to $250. So on October 15, 2019, NVIDIA gets an upgrade from many financial institutions such as Bank of America and so on. So the major catalyst behind the upgrade was NVIDIA's performance and an increasing demand of its products. Following the upgrade, NVIDIA shares rose throughout the day. So catalyst kicks in here. There's an upgrade. We think NVIDIA is worth more, right? NVIDIA is not trading at 250 or 225 or whatever. NVIDIA is trading around 200. So with that being said, we think NVIDIA is worth 225 to 250 because there's a huge demand. That already makes this a stock that we are now watching. It's on our watch list. It's on our radar. We then go to price action, and if there's a certain play on price action, we as traders go, cool, execute. There's already fuel behind the play. All we need is confirmation on price, and that gives us the phenomenal play. Now, just to recap on Catalyst, Catalyst, once again, is anything that has the power to make a stock go up or down, earnings, any sort of news, economic events. Any of these are known as catalysts. So when you guys hear these terms or hear this term catalyst, that's what it is. Your job as a trader, depending on how you trade, is not to understand catalysts. Me personally, I like to trade stocks that have catalysts behind them, especially if I'm day trading, because these are the stocks that are going to make the biggest moves up or down or have a possibility of making a good play, right? So I like to look for catalysts. What I want you guys to do is I want you guys to understand catalysts, go through stocks, see what the catalyst is, see how the catalyst makes the stock go up or down, and be very familiar with that. So when you are taking a trade, when you have real money invested, when you are trading, you understand how to approach different scenarios and you understand the whole marketplace.